Hi, good day. So this is my fourth video. Welcome. Today we're going to talk about standard costing and variance analysis part 1. So inclusive in this lecture video is only the variances for raw materials. So if you wanted to have knowledge on the variances related to direct labor or the variances related to overhead, then you need to wait for part 2. So this is me again. Let's PE kasama. So I've chosen this topic because most of the students find it very difficult to solve problems related to standard costing and variance analysis. Most of them tries to memorize the formulas, which can only be committed to short-term memory. So our goal is to understand the topic so that the topic, the understanding, the concept of standard costing and variance analysis will become part of the long-term memory. So this lecture video is composed of 5 main contents. So the first one is the concepts and definition of terms. The second is the illustrative problem, because I do believe that what you have understood, the concepts and etc. should be applied kaagad in illustrative problem. Third one is the analysis of the given information. So based on the illustrative problem, we're gonna extract the information that are necessary for variance analysis, and we're going to interpret the information, because you will not be able to compute or do a variance analysis or understand variance analysis without the proper extracting and interpreting of the information in a given situation or in a given problem. Fourth, we need to differentiate the budgeted cost versus the standard cost versus the actual cost, not just conceptually, but we will try to have a computation so that you will see what is really the difference between the three by using the illustrative problem. And the last is our main goal. It's to do the variance analysis, and since this part 1 is only for raw material variances, so I have price variances, quantity variance, mix, and yield variances. So enjoy the content of this video. So we are here on the concepts and definitions of terms. So since our topic is all about standard costing and variance analysis, let's talk about terms that are related to the topic. First is standard. What is this? In layman's point of view, it is just the minimum acceptable quality or quantity of something. Let's say, for example, in real life situation, what if you're going to be asked, what is your standard with a lifelong partner? Of course, you're going to answer some qualities, some characteristics of that person. So that is your standard. But since we need some business related example, so here it is. Example, the company is expected to produce 100 products in a day. So this type of expectation does not happen in a snap. This is a result of a study, long-term study of historical experiences of the company, as well as long-term study of the operations of the company. So for example, the capacity of the machines that you have, or the capacity of the people that are working for you, or the available raw materials per day. So those things are considered, or the demand of the product. So this has many things that has been considered. So for example, in a certain day, you have not reached the 100 products. For example, you have only produced 70, or you might have produced 150 versus the 100, then there is something wrong. Well, not something wrong, there's something odd, so you need to investigate. That's where variance analysis comes, because variance analysis is just an investigation to find out the reason as to why the actual is different from what is expected. Next term, we have standard production costs. Standard production cost is just the expected production cost per product. So you will not be a good businessman if you cannot give the production cost of your product. For example, you should be able to say that our product costs 115 pesos per unit. So let's say, for example, the raw materials of our product normally cost 300 pesos. But then again, this standard production cost is still a result of historical experiences of the company and the operations of the company and the suppliers' pricing and the economy and etc. So that's standard production costs. We have also production requirements. Production requirements is not related to monetary values at all. However, these production requirements, the same with the standard and standard production cost, has been studied, has been a result of what has been experienced in the past of the company. So let's give an example for you to relate. Example number one product uses 2.5 meters of raw material A and 1 meter of raw material B. Example number 2, each product can be processed for 10 minutes each. So that's it. Those are the most important terms related to standard costing and variance analysis. And now it's time to go to the illustrative problem. So we are now on the illustrative problem. So I'm going to speak as slowly and as clearly as possible in order for you to follow, because we're gonna talk about numbers already. So let's start. ABC company forecasted in 2019 that in the year 2020 the company will make or produce 1.2 million anti-COVID tablets or 100,000 tablets monthly. So disclaimer, I don't know anything about formula of medicines or pharmaceuticals. I just made this illustrative problem so that we'll be able to compute and apply the concepts that we have talked about a while ago. So details from the master budget and production requirements are as follows. Let's talk about the raw materials. The raw materials for a 1 tablet, which is 350 milligrams, it is composed of chemical A, 150 milligrams of it, and 225 milligrams of chemical B. Each milligram of chemical A costs 1 centavo, while each chemical B costs 0.75 centavos. Next is on the direct labor. A single tablet can be manufactured in 40 seconds. The workers are paid, on the average, 50 pesos per hour. On the variable overhead, variable overheads are computed to be 65 pesos per hour. And on the fixed overhead, this is budgeted at 900,000 annually or 75,000 monthly. So, the actual data for the month of January consists of the following information. So that means January has come to pass. So this is the actual data. The actual output that has been produced by the company is 97,000 tablets versus the 100,000 tablets monthly, which is included in the plan. So it's lower than the expectation. Next, the chemical A used is 14,700,000 milligrams for an amount of 149,940. And the chemical B used is 19,600,000 milligrams for 145,000. Don't worry about the big amounts, 14.7 million and 19.6 million, because we're talking about milligrams. Another is the direct labor used is 1,100 hours for 56,100 pesos. And the variable overhead is 71,368 all in all. Plus the fixed overhead is 73,000. So in this video and in the future videos, we're gonna use this illustrative problem. And our job is always to prepare standard cost and variance analysis. But for this particular video, you need to focus only on the raw materials. So everything else should be eliminated in your mind as of this moment, as of this video. Now, what are the things that you need to remember for this video, for this lecture video? First, the company wants or expects to produce 1.2 million anti-COVID tablets or 100,000 tablets monthly. As to raw materials, you need to remember three things. The first one is 1 unit or 1 tablet is 350 milligrams, and that it is composed of chemical A, 150 milligrams of chemical A, and chemical A is priced at 1 centavo per milligram, and chemical B, 225 milligrams of chemical B, and each milligram of chemical B costs 0.75 centavos. So, on the actual of January, you need also to remember that the actual output of the company for the month of January is only 97,000 tablets, and the chemical A used is 14,700,000 for 149,940, and the chemical B used is 19.6 million for 145,000. You need to remember all of that for the next portion of our video lecture. So, we are on the analysis of the given. So, I have presented you already a while ago the illustrative problem. But if you didn't get the most important information, I'm gonna get back to that. So, on the illustrative problem, it has been mentioned that 1 unit of product or the tablet is a 350 milligram output. Now, it needs chemicals. So, for example, it needs 150 milligrams of chemical A, and chemical A is priced at 0.01 or 1 centavo per milligram. So that is what do we call the budget price or the standard price. So let me make it clear, the budget price is the same with standard price when it comes to variance analysis for raw materials. So we have also chemical B. You need 225 milligrams of chemical B in order to produce 1 unit of product, and it's priced 0.75 centavos or 0.0075. So that's the raw material standard that has been mentioned in the illustrative problem. But by the way, I would like to emphasize that for the purpose of this video lecture, when I say standard, it is composed of production requirements, just like this one, and the standard prices, like this 1 centavo and the 0.0075. Now, standard cost is different from the standard that I'm talking about, and you will understand it later. But I would also like to remind you that not only this one is the most important one in variance analysis, there are also other types of information, like the planned production of the company is 1.2 million for the year 2020 or 100,000 per month. And the actual production of the company for January is 97,000 units only. And for the month of January also, the actual quantity of chemical A used is 14.7 million, which is priced at 149,940 in total. The actual quantity used for chemical B is 19.6 million also, for a total cost of 145,000. So those are all the important information that you need in order to conduct a variance analysis. So let's further analyze the given. So let's start with the total of chemical A and chemical B is 375 milligrams, which is more than the output of 350 milligrams. So therefore, we conclude that there are inputs that has been lost during the process, and that is normal for products with more than one type of raw materials. Next is, when you multiply the quantity versus the price, you're gonna get the cost. So For example, chemical A, the 150 milligrams times 1 centavo, you're gonna come up with 1.50. So that's the cost of chemical A per unit of output. On chemical B, you have 225 times 0.0075, you have 1.6875. So all in all, the total cost per output based on the standard is 3.1875. That's layman's term. But actually, technically, it's called standard output cost. So, standard output cost can be solved by using the cost of all the materials per unit over the number of units produced. So, I have emphasized this because sometimes there are problems that the material requirements is not intended for 1 unit of product, but instead, it is intended for 1 batch of products. So, in order to get the standard output cost per product, then you need to follow this one. So, we're already through with standard output cost. To further analyze, we have what do we call the standard input cost. The standard input cost is the cost in the average for each of the inputs, since our input is in milligrams, chemical A and chemical B, and they are all 375 milligrams. So you just need to divide the 3.1875 divided by the number of inputs, both chemical A and chemical B, and you are going to get the standard input cost. Again, this is the standard average cost per input, the 0.0085. Now, part of the analysis is the analysis for the mixture. As you can see, chemical A is about 150 milligrams over 375 milligrams. So meaning chemical A is composing 40% of the overall mixture of 375 milligrams. While chemical B, even if we do not solve, we can get that it is 60%. But for the purposes of discussion, we need to solve it. So you have 225 milligrams over the 375, then you're gonna get 60%. So that is the standard mix. Now, expected yield can also be extracted from this information. So, expected yield is for every 75 milligrams of input, 350 milligrams of output is produced. So meaning, if we're gonna solve it, how much will be left of the input when it becomes an output? You're gonna have to divide 350 milligrams over 375 milligrams, then you're gonna come up at 93.33%. So again, the 93.33%, the meaning of this, if the inputs is 100%, then the output will only be 93.33%. So meaning 6.6666% has been lost during the process. So that's the end for our analysis of the given. So let's go to number 4. We need to differentiate budgeted cost versus the actual cost versus the standard cost. Now, let's start with the budgeted cost. In order to compute the budgeted cost, there are requirements. Number 1 requirement is the standard or production requirements, which is this one, the 150 milligrams and 225 milligrams of chemical A and chemical B for 1 unit of 350 mg tablet, and as well as their prices. Number 2 is the planned production. So in the illustrative problem, it has been said clearly that the company is planning to produce 1.2 million units per year, or 100,000 units per month. And we're just going to talk about 1 month, January 2020. So we better use the 100,000 units per month. So how do we compute the budgeted cost? Let's say, for example, for chemical A, you use the planned production, 100,000, and then you multiply it with the quantity needed per output. So in this case, chemical A, 150 milligrams. So 100,000 times 150 is 15 million milligrams, and that is what do we call as budgeted quantity. Now, you multiply it with the budgeted price or standard price, then we have 0.01 or 1 centavo. So how much is the total raw material cost of chemical A? That is 150,000. That is what do we call as the budgeted cost. Now let's do the same with chemical B. Chemical B, land production is 100,000. You multiply it by 225 and you're gonna come up with the budgeted quantity of 22.5 million times 0.0075, you have 168,750. So all in all, the total raw material cost, the budgeted raw material cost is 318,750 pesos. Now, that's all for the budgeted cost. Let's go to actual cost. So you focus on blue colored letters. So on the actual cost, it has already been given in the illustrative problem. The actual quantity used is 14.7 million for chemical A, and that the total cost, the total actual cost that has been paid is 1,499.40. Now, in the actual cost, you don't need really to get formulas in order to get the actual cost, because it necessarily happens. What happens? What is the amount actually incurred? That's it. So in the problem, the actual cost was given and the actual quantity used. However, in some problems, the actual cost will not be given. Instead, you'll be given the quantity and you will be given the actual price. So what do? You need to get the actual price in order for you to multiply actual quantity to actual price. So in this case, if we want this one to be complete, then we can derive the actual price per milligram. How? You just have to divide the actual cost of 1,499.40 divided by 14.7 million, and you're gonna come up with 0.0102. So let's go to chemical B. Chemical B, the actual quantity that is used by the company according to the problem is 19.6 million. The total cost is 145,000. Let's do the same with chemical A. Let's get the actual price by dividing 145,000 with 19.6 million. Then you're gonna get 0.0074. So the total actual cost for both chemical A and chemical B is 294,940. That's it for the actual cost. Sir, what about standard cost? Let's go to standard cost. By the way, before we go to standard cost, this actual cost that was completed is for 97,000 tablets or outputs that has been produced by the company. Let's go to standard cost. Standard cost, focus on reddish letters. So there are requirements in order to compute the standard cost. The first one is very much similar with the computation of the budgeted cost, because the first requirement is standard or production requirements. This one again. But they're different with the second requirement, because standard cost can be computed only if there is actual production. So they differ in that aspect. So let's compute for the standard cost. We have chemical A. You get the actual output of 97,000, and then you multiply that one with the quantity per unit based on the production requirement, that is 150. So the total will be 14.55 million. That is what we call a standard quantity. So as you can see, the budgeted quantity is not the same with the standard quantity. Now, you multiply the standard quantity with the standard price, which is 1 centavo. Remember when I told you that the budgeted price and the standard price is the same? They are really the same. So you're gonna come up with the standard cost of chemical A, which is 145,500. Let's do the same with chemical B. Chemical B, 97,000 times 225, then the total will be 21.825 million. You multiply it by 0.0075, so the total standard cost is 163,687.5. So for both chemical A and chemical B, the total is 309,187.50. So that's the plan based on actual production. This is the standard cost, and this is the 100% plan, and this is the actual. Now the question is, which of the two will be compared to the actual cost, the 294,940? Is it the budgeted cost of 318,750 or 309,187.50? And the answer is clear. Logically, you need to compare the standard cost with the actual cost, because the standard cost is based on 97,000 units and the actual cost is 97,000 units. You do not compare the budgeted cost with the actual cost, because this is based on 100,000 units. So that's it. Let's go to number 5. So let's go to the variance analysis. This is the focal point and the main goal of our video lecture. It's to perform the variance analysis. As you can see, I have put here the full analysis of the given illustration, so that we'll be able to pick up whatever is needed in our understanding here and computation of variance analysis. So as I've said, the standard versus the actual ang labanan. So in the problem, chemical A, the actual quantity that is being used is 14.7 million, and the actual price is 0.0102 per milligram, and the total actual cost that has been incurred is 149,940. You need to compare it with the standard quantity, which is 14.55 million times the standard price of 1 centavo or 0.01. So we have 145,500. So it is clear that there is a difference, and we need to find out or to investigate why there is a difference. So there might be two reasons why the actual cost is different from standard cost, and that is price and quantity variances. So as for price, maybe if the price became lower in the actual or higher in the actual, then there will be a difference between what is expected and what is in the actual. Let's say, for example, the price has been increased because of inflation or the economy, something like that, then that is what we call as price variance. Now, quantity variance or usage variance talks about the usage of chemicals. So according to the plan, you should only use 150 milligrams and 225 milligrams of chemical A and chemical B in order to manufacture one tablet. But if, let's say for example, you have consumed 175 milligrams of chemical A per unit of tablet and 250 milligrams of chemical B per unit of tablet, then there will be a quantity variance or usage variance, because the actual proved to be inefficient than expected. So how do we get the price variance? So if we wanted to have to get the price variance, you need to get a product from 14.7 million times the standard price of 0.01, which is 147,000. So what does this mean? As if we are getting the actual quantity that has been used, and then we are multiplying it with what is expected na price, which is 0.01. So we have 147,000. So even if we purchased 14.7, the actual quantity, if the price has been followed based on the expectation, then we're gonna get 147,000. But it's not the case. Why? Because in the actual, the price per milligram is 0.0102. So there is a difference in this one. So that is what do we call as price variance. So meaning we can conclude that in the actual, the cost per milligram is higher than what is expected. So the answer is positive 2940. That means this is unfavorable in our company. Why? Because the actual is greater than the expected costs. Okay, so sir, how about the quantity variance? Now, quantity variance is easy because you just have to deduct 147,000, the actual quantity which is expressed on the expected price of 147,000. You deduct it with the standard price, and there you go, you have the quantity variance. So let's analyze further. As you can see, the prices are the same. We assume that the prices are constant. That's based on the plan. What's different between these two is the actual quantity and the standard quantity. So we wanted to know if ever the company has been efficient in using the raw materials or not. And as you can see, the company is not efficient, because if we follow the plan, the company should have used only 14.55 million of chemical A if we are going to produce 97,000 products. But in the actual, we have consumed 14.7, so as if there is so much waste or so much used. So there is a quantity variance of 1.5. Again, it's positive because this is unfavorable in our part, because as you can see, the actual used is 14.7, the plan is only 14.55, so meaning we are inefficient. So that's how you get the price and the quantity variance. So no need to memorize lengthy formulas for price variance and quantity variance. Actually, I have only memorized two. The one is AAS, patterned on this actual quantity, and standard quantity, AAS. That AAS pattern will be used also in the direct labor variances and variable overhead variances. And another formula that I am remembering is ABAS for the fixed overhead. That's it, the AAS and the ABAS. So when I compute variance analysis, I have only two, AAS and ABAS. Let's do the same with chemical B. So actual quantity 19.6 million times actual price of 0.0074, you have 145,000 as the total cost, and then you wanted to get the price variance. So the quantity will be assumed fixed. What is the expected price? That's what we're going to put it. That's what we're going to put here. So that's 0.0075. So the total is 147,000. So if we have purchased 19.6 million chemical B using the prices set at the standard, then you are going to pay 147,000 only. So as you can see in the actual, as if we have saved, because we only incurred actually 145,000 versus 147,000. That's why the price variance in here will become favorable. So let's go to the third before we go through the price variance and quantity variance. So according to the problem, we have the standard quantity is 21.825 million and the standard price is 0.0075. So we have 163,687.50. So meaning if we followed the plan, the quantity that should have been used is 21.825, and in the actual you have only used 19.6 million. So meaning you have saved on the chemical B unlike on the chemical A. So we're expecting favorable variances. So on the price variance, we have negative 2,000. That is favorable on our part because the chemical B is much cheaper actually when compared to what is expected, and that the usage of our raw materials, supposedly if we follow the plan, we should have used 21,825. We only used 19.6. So, meaning it's still negative or favorable 16,687.5. So, the variance analysis does not stop here. For example, on the price variance of 2940, you need to find the specific reason why the actual price is not the same as expected. It could be because of the falling economy or extreme inflation, or it's normal but you haven't predicted it, because you need to get the specific reasons, because you are going to make another standard based on impressions, based on the result of your investigations on price and quantity variance. Besides, the beauty of this format is when you're going to use this format, some of the problems does not give you a straightforward problem just like this, like they are going to give the actual quantity, standard quantity, standard price, etc. Sometimes they're gonna give you the price variance and then something is absent in here. But since if they're going to give the price variance, for example, and that this one is the 149940 is absent, the 147 is given, you can work back. So there's no need for formulas, you just work back. So that means 2940 plus 147,000, you're gonna get the 149940 even if it is not given. Or if 149940 is given, however the actual price is not, as what we did earlier, we can derive the actual price, 149940 divided by 14.7. So basic mathematical procedures lang, okay na. So that's it for the price and quantity variances. So if you add this 2940 plus 15, so that is the difference between the actual cost versus the standard cost. Now that's it. We have another two types of variances, the mix and yield variances. So what are these mix and yield variances? First, we need to compute first the total quantity variance. The total quantity variance for chemical A, the quantity variance is 15. And for chemical B, that is negative 16,687.50. So the total is negative 15,187.5. Why did we start with the total quantity variance? Because this total quantity variance can still be subdivided into mix and yield variances. So mix plus yield variance is total quantity variance. So what are these two? These are the ones that will affect your quantity variance or usage variance. Let's say for example, mix variance. So in our analysis, we have our mixture here. So if we're gonna follow that chemical A is 40% of the total mixture, chemical B is 60% of the total mixture, there will be no mix variance. Or even if you will not follow the chemical A and chemical B percentages, basta their prices are the same, for example they are both 1 centavo or 0.01, then there will be no mix variance. So how does not following the mixture, the standard mix, affect the quantity variance? Let's say for example, chemical A that was actually used did not follow this one. Instead, what was followed is 50% chemical A. So it follows that chemical B, you have also used 50%. So in the mixture, that's 50-50. Now, on the standard, it should have been 40 for chemical A. So meaning you have used more than what is expected. And if you have used more than what is expected of chemical A, remember that chemical A is much more expensive than chemical B. So there will always be a quantity variance if that happens. Now, let's go to yield variances. It is expected that for every 375 milligrams of input, 350 milligrams of output is produced. So there will be a yield variance if you cannot follow this. Let's say for example, 400 milligrams of input was needed in order to make one output. So the expected yield that we have was not followed. That's why there will be yield variances. So if there are yield variances, of course, that means based on my example a little while ago, the quantity variance will become bigger and it's unfavorable because you have used more than what should be used based on this standard or expectation. So that's mix and yield variances. The next question is, how do we compute mix and yield variances? So you need to follow this one. If you wanted to, you can pause, you can rewind so that you can be able to follow every step of the way. So let's compute the mix variance. There are actually two methods that I'm going to introduce to you. Let's start with the method 1. So when computing for mix variance, you just need the actual milligrams used for chemical A and chemical B. For chemical A, that's 14.7 million and chemical B is 19.6 million. So all in all, the total input that was used is 34.3 million. Now imagine that 34.3 million, you have followed the mixture. That means 40% for chemical A. So 34.3 million times 40% is 13.72 million. So those are the milligrams based on standard mix. So the actual milligrams used of the input, both chemical A plus chemical B, times 40% is 13.72 million if we follow the standard mix. And of course, 60% is 20.58 million for chemical B if we followed the standard mix. So it's very clear that we have not followed the standard mix. Why? As you look at chemical A, you used 14.7 million. If you have followed, it should have been 13.72 million only. So there is what do we call a difference. So we used more chemical A. So expect that there will be a mix variance. So on the side of the chemical B, you used 19.6 million. You have not followed the standard mix because the standard mix states that if ever you follow the 60%, then you should have used 20.58 million. So there is a difference of 980. So how do we compute the mix variance? You multiply those with the standard prices. Again, the standard price is 1 centavo for chemical A and 0.75 centavo for chemical B, or 0.0075. So that's 98, the mix variance, and of course the negative 7350. This is unfavorable, this is favorable. We need to explain why is it unfavorable. As you can see, there are more chemical A's used actually versus the expectation. So meaning that's unfavorable. Whereas on the chemical B, the actually used is 19.6. The plan or the expectation is 20.58. So meaning we have saved for chemical B as to the usage. So that's favorable or negative. So the total mix variance for this one is 2450. So that's how you get the mix variance under method 1. Now let's go to yield variance using method 1. You need to get the expected output first. How do you get the expected output? You get the total inputs, 34.3 million. And since it is said that for every 375 milligrams, there is an input of 350 milligrams of output. 350 milligrams is 1 tablet. So that means 34.3 million, the actual input, the total actual input used, divided by 375 milligrams, then the supposed to be tablets that you'll be able to produce if you have followed the plan is 91,466.666666 and so on. The actual output is 97,000. So that means you have exceeded the expectation, and that excess is 5,533.33 tablets. So you have yield more than the expectation. So this is favorable. And then you multiply that with standard output cost. So standard output cost again is the cost per output. So that's 3.1875 per tablet. So you multiply that and you will have a yield variance of negative 17,637.50. And if you add these two, you're gonna get the quantity variance of 15,187.50 here. So again, the total quantity variance can be divided into mix and yield variances. So that's on the method 1. Let's go to the method 2. So method 1 is for concept-based approach. Method 2 is for ease in computation. So this is the method 1. Let's compare it with method 2. Ease in computation because on method 2, it's very similar with price and quantity variance, in which you have only 3 lines. And then you deduct the first line with the second line, that is already the mix variance, and the second and the third line, if you deduct the difference, will become the yield variance. So the pattern is much similar to price and quantity variance that I've discussed a little while ago. So let's go to the first line. Chemical A. The actual milligrams used is 14.7 and the standard price is 0.01. You multiply and you're gonna get 147,000. Next, chemical B. Use the actual milligrams used, that's 19.6 million, but use the standard price, or what is being mentioned on the production requirement. It's 0.0075. So you didn't use the actual prices, you used the standard prices, although you used the actual milligrams used. So you add them. Coincidentally, that's also 147,000. The total is 294,000. That's the first line. The second line, you get the total actual input. That's 34.3 million here, because 14.7 and 19.6 of chemical A and chemical B totals to 34.3 million. And now you multiply this one with the standard input cost. Again, the standard input cost is the total cost per output divided by the number of inputs needed in order to produce one output. So you have 0.0085. Use that. And then you have the second line already. The total is 291,550. The third line is get the total actual output. You have 97,000 units, and then you multiply it with SOC, or standard output cost. Standard output cost again is 3.1875. And if you got that, and you multiply it with 97,000 units, you have 309,187.50. So the first minus the second is the mixed variance. You have 2450, the mixed variance. And second minus the third, it's the yield variance of 17637.50. So those are the methods in order to compute the mix and yield variances. But the most important thing is you need to understand what's mix, what's yield, what's price, what's quantity variance. Why is it unfavorable? Why is it favorable? And then you have it. So this is the end of part 1. So you just need to wait for the part 2 for the direct labor variances and the factory overhead variances. So if this helped, then click subscribe and hit the notification bell, as well as like or comment if you have questions, and share. Thank you.